Hello, everyone, and welcome back to Gold Off the Charts. In a financial market defined by volatility, power plays, and uncertainty, we don't just watch the show, we look for the hidden logic behind the moves. A little deep financial thinking every day can help you see further, walk steadier, and outlast the competition on the road to building wealth. In today's video, I have to start by warning you. We are witnessing the birth of an era of madness. If you haven't noticed the shift in how wealth is being redefined, you might truly be left behind. Looking at the market over the last couple of days, gold isn't just rising, it's taking flight. Tuesday's close saw a 3.45% jump. By the Wednesday Asian session, gold shot up like a rocket, hitting an all-time high of $5,247. People, this isn't a minor move, it's a historic leap. And what about silver? Silver's performance has been even more of a heartstopper. It broke $117 on Monday, but by Tuesday, it was a total roller coaster, dipping below $106 at one point. Just when everyone thought the rally was over, it snapped back to close above $112, marking a single-day gain of over 8%. As of Wednesday's Asian session, silver is holding strong around $115. What kind of massive force is driving this high-level volatility and gravity-defying rally? Why is global capital flooding into gold and silver like crazy? And why are even the smartest Wall Street banks getting caught off guard? Today, I'm going to pull back the curtain on this madness. We'll discuss Trump's yo-yo theory that has global officials in shock. We'll break down the tightening web of conflict in the Middle East and, more importantly, expose a shocking contrast that most people are missing, one that will dictate wealth for the next decade. The center of power in the gold market is undergoing a historic shift to the east. After watching this, you'll understand why $5,200 might just be the starting line, and why a $10,000 price target is no longer just a fantasy. Let's start with the immediate trigger. Looking at trading screens worldwide over the last 2 days, the US dollar index chart looks absolutely brutal. The dollar plummeted 1.33% to close at 95.75 on Tuesday, even hitting a 4-year low of 95.57 intraday. In the world of currency trading, a 1% move is a massive earthquake. And the epicenter of this quake is the man in the White House, the ever-unpredictable President Trump. While taking questions in Iowa on Tuesday, he said something that made central bankers want to pull their hair out. When asked if he was worried about a weakening dollar, Trump looked completely unbothered and said, "No, I think the dollar is doing fine." He continued, "Look at our trade. The dollar is doing well. I hope the dollar finds its own natural level. That's only fair. Sounds reasonable on the surface, right?" But here's the kicker. He actually suggested he could manipulate the exchange rate himself. He said, "I can make the dollar bounce up and down like a yo-yo." Let that sink in. For decades, we've been told the US dollar is the anchor of the global financial system, the world's most stable asset. But now, the US president is telling you, the dollar is my toy. I'll make it rise or fall whenever I feel like it. This yo-yo theory has sparked total panic in the markets. Investors are realizing the dollar is no longer a safe haven. It's actually become a major source of risk. In his speech, he also took swipes at Japan and South Korea. He called it unfair that they are supposedly devaluing their currencies. The subtext? He's ready to jump into a full-blown currency war at any moment. He's willing to actively drive the dollar down. Even though Trump claims he isn't worried, analysts think this downward slide is just getting started. Long-term, the dollar is facing a mountain of trouble. The Fed's loss of independence, a ballooning budget deficit, and extreme political division are all structural rot eating away at the dollar's foundation. Elias Haddad from Brown Brothers Harriman noted that global confidence in U.S. trade and security policy is fading fast. Combine that with the politicization of the Fed, and the downward pressure is completely drowning out any neutral economic news. As the dollar tanked, the yen, euro, and pound all skyrocketed. The euro-dollar pair even broke above 1.2 for the first time since 2021. The market is drowning in dollar distrust, and the cost of short-term options insurance has hit its highest level since 2011. Everyone is frantically buying protection, terrified the dollar will keep sliding. To make matters worse, Fed Chair Jerome Powell's job security is now in total limbo. Speculation is rampant that Trump might fire Powell right after Wednesday's rate decision, especially now that his administration has launched a criminal investigation into him. When a president treats a national currency like a yo-yo and tramples on central bank independence, where does the smart money go? They go to the one physical asset that no politician has been able to manipulate for thousands of years: gold. If the weak dollar is the fuse, then geopolitical risk is the gasoline being poured on the fire. The second big reason gold is hitting new highs is the total breakdown of global stability. A recent leak has the markets feeling very uneasy. The U.S. reportedly told Israel that military preparations against Iran are in the final stages. Sources say the U.S. side of the prep will be done within 2 weeks. We could be looking at a window for action in the coming months. Folks, this isn't a conversation about trade tariffs. This is a war that could paralyze the world's energy supply. Trump was still talking about a deal with Iran on Tuesday, but his other hand was moving troops. He even said, "A fleet is heading toward Iran. We'll see what happens." This is a clear signal to the market: make a deal, or I'm moving in. The USS Lincoln Carrier Strike Group is already in the Middle East. This isn't just for show, it's a rehearsal for a surgical strike. Meanwhile, Iran's response is keeping everyone on edge. Iranian officials claim they now have comprehensive AI-driven real-time monitoring of the Strait of Hormuz. The message is loud and clear. "We see everything on the surface, underwater, and in the air. We control this strategic gateway." In other words, Iran has its hand on the throat of the world's oil supply. Between 20% and 60% of the world's crude oil passes through that narrow strait. If Iran shuts it down, global oil prices will skyrocket, and the global economy could collapse overnight. Even more interesting is Saudi Arabia's stance. Saudi Crown Prince MBS reportedly told the Iranian president that Saudi airspace and territory will never be used for a military strike against Iran. This creates a high-stakes geopolitical deadlock, pushing the U.S.-Iran confrontation to a boiling point and scaring investors away from stability. Michael Widmer from Bank of America pointed out that gold rallies usually end when the initial scare fades, but this time, it's the opposite. Uncertainty isn't fading, it's amplifying. From the deserts of the Middle East to disputes in the Arctic, the old global order is being torn apart. In this new normal of constant crisis, money has nowhere to run but gold. One analyst put it brilliantly. Usually, the gold rally stops when the driver disappears. This time, the driver uncertainty is just getting bigger like a snowball. When the world loses faith in the word stability, gold stops being just an investment. It becomes the only escape pod left in the room. Now, let's get to the most important yet least talked about part of today's topic. If you ask me what makes this gold rally different from others in history, I can summarize it in 3 words: the Eastward Shift. Many people are still using 1970s reasoning to trade this market, but I'm telling you, if you do that, the market is going to teach you a very expensive lesson. The players, the motives, and the center of gravity for gold have fundamentally changed. Asian buyers have moved from being background characters to being the lead stars of this show. Let's look at this financial revolution in detail. First, check out this shocking comparison. In the 1970s gold bull market, Western investors called all the shots. Back then, demand from Asia, mostly China and India, was only 15% to 20% of the market. The West controlled 68%. Gold prices lived and died by the mood of London traders and Wall Street's inflation views. Fast forward to the 2020s, and the script has flipped. Today, Asia's share of gold demand has exploded to between 49% and 60%, while the West's influence has shrunk. The real powerhouses are the big two, China and India. The World Gold Council reports that China and India's share of global consumption has jumped from 20% 30 years ago to nearly 50% today. This is a massive shift. In China alone, since their gold market opened in 2002, annual consumption has grown 5-fold. Furthermore, Asian buyers are much more disciplined. We saw this clearly in 2022. Western investors were dumping gold ETFs because of rising interest rates. Gold prices started to dip. But what did Asian buyers do? They stepped in and bought the dip immediately. The result? 527 tons of gold moved that year. It literally flowed out of New York and London vaults and headed straight for the east. This is the great migration of gold. This physical demand, that's what kept gold prices from crashing during the Western sell-off. It's a clear display of Asian power. This is the structural difference from the 1970s. Back then, Western central banks were the main players, but their strategy was simple: sell. They sold gold to boost liquidity and fight inflation. Today, it's the exact opposite. Emerging market central banks, China, India, Turkey, Poland, etc., have become super buyers. The numbers are staggering. From 2022 to 2024, central banks bought over 1,000 tons net for 3 years straight, the highest level since 1967. Look at China's central bank. By the end of 2025, they had increased their gold holdings for 14 straight months. Their reserves now sit at roughly 2,280 tons, up 1,225 tons from a decade ago. Their motivation isn't just profit. It's a strategic move to de-dollarize and protect against geopolitical fallout. India isn't far behind. The Reserve Bank of India's gold holdings have climbed from 357 tons in 2000 to over 800 tons today. But here is the hidden opportunity. Even with all this buying, gold only makes up 9.5% of China's reserves and about 7.5% of India's. Compare that to the US at nearly 80% or Germany at 66%. What does this tell us? It means Asian central banks have a massive amount of buying left to do. This isn't a trend, it's a long-term plan. Goldman Sachs expects this central bank buying to last at least another 3 years. This is the iron floor under gold prices. This is why Western analysts keep getting it wrong. They underestimate the East's commitment to moving away from the dollar. We used to say the price in Asia follows London, and London follows New York. Not anymore. The Shanghai Gold Exchange is now a powerhouse alongside London and New York. In 2025, the SGE handled 30% of the world's physical gold trade. Asian trading hours used to be dead time for markets. Now, volatility during the Asian session has spiked. We're even seeing Eastern price discovery, where Asian markets rally and the West has to play catch-up. Asia is now a price maker, not a price taker. In the 70s, it was all about US, inflation, and the dollar. In the 2020s, we have a structural shift. Sell in the West, buy in the East. The West is offloading US dollar assets, and the East is snapping up physical gold. This has completely rewired the power dynamics of the market. As Goldman Sachs predicts, this mysterious force from the East is the ultimate long-term support. So, if you see gold prices dip, don't panic. Check if the Eastern buyers have stopped. They are the real weather vane now. You might not realize just how embarrassed Wall Street analysts have been lately. Look at Morgan Stanley's previous forecast. They predicted gold would hit $4,750 in the second half of 2026. Well, it's only January 2026, and we're already past $5,200. They didn't just miss the mark, they were completely blindsided. Now, they're scrambling to hike their target to 5,700, and even then, they admit they don't see a top in sight. Why are their models failing? Because they're using linear models for an old era, but we are in a non-linear, chaotic era. Deutsche Bank and SocGen are even more aggressive, calling for 6,000 by the end of the year. But the most interesting take comes from BMO Capital Markets. They suggested a new world order scenario. If central banks keep buying at this pace and ETF money keeps flowing in, combined with the collapse of dollar credibility, gold could hit $6,350 by late 2026. By the end of 2027, they think it could hit a staggering $8,650. Some are even whispering about gold 10,000. Sounds crazy? People thought it was crazy in the 70 seconds when gold went from $35 to $850, a 20x jump, and there's another ticking time bomb to watch: Japan. Japanese bonds are being dumped, the yen is swinging wildly, and there are rumors of joint U.S.-Japan intervention. The yen hit 152.76, But this forced strength only makes investors more suspicious of traditional paper assets. All this chaos is funneling money into gold like a vacuum. So, after all this analysis, the question everyone is asking is, what do I do? Is it too late to buy at $5,200? Let's be clear. Gold has entered a brand new, high-volatility, explosive phase. Silver's wild moves were just a warm-up. In the future, seeing gold drop 100 and jump 150 inches a day might become the new normal. For ordinary investors, I have 4 practical pieces of advice. First, get over your fear of heights and accept the trend. People see $5,000 and think it's expensive, but you have to understand, gold isn't getting dearer, money is getting thinner. In this new world order, yesterday's ceiling is today's floor. As long as war risks and de-dollarization persist, the bull market is alive and well. Second, watch out for profit-taking stampedes. When gold runs too far, too fast, it will have a washout like silver did on Tuesday. Don't let short-term volatility scare you. And don't FOMO, fear of missing out, into a massive position at the top. Learn to scale in, split your capital into 3 or 5 parts, and use every big dip as a chance to buy. Third, watch silver for its leverage effect. Silver moves more violently but follows gold's lead. Silver's industrial use, especially in AI and clean energy, combined with its safe haven status, makes it even more explosive than gold during a precious metals boom. But remember, silver is a high-risk game. Don't bet more than you can afford to lose. Fourth, watch the Asian markets. Pricing power has moved east. The price gap between London and Shanghai is the best indicator of where the money is moving. If Asian buying stays strong, a Western sell-off is just a gift entry for you. Overall, this gold rally is no accident, and it's certainly not a bubble. It's the result of geopolitical risk, the decay of the dollar's credit, and the awakening of Asian economic power all coming together at once. We are at a turning point where the rules of wealth are being rewritten. In the past, gold followed interest rates. Today, gold follows aircraft carriers in the Middle East, Trump's yo-yo, and the Chinese central bank's balance sheet. Expect a bumpy ride with plenty of shakeouts, but in this chaotic world, $10,000 gold is most certainly back on the table. This is a historic opportunity we might only see once in a lifetime. Finally, a quick reminder, all of this is my personal analysis based on current news and market rationale, designed to help you organize your own thoughts. I want to help you cut through the noise. This is not direct financial advice. Trading is risky. Always be cautious. Everyone's financial situation is unique, so you must make your own decisions based on your own risk tolerance. Investing is a journey. Use others' views for reference, but trust your own judgment. That's all for today. If you found these insights helpful, or if they helped clarify the market for you, please leave a comment below with your take. Don't forget to like, subscribe to Gold Off the Charts, and share this with your friends. See you in the next video!